My name is Bill Fenton. I'm with Bank of America and Vice Chair of NAAHL's board. Thank you again for being here. We'll give you final remarks after our last speaker. The Comptroller of the Currency is the administrator of the federal banking system and head of the Office of the Comptroller of the Currency. The OCC supervises more than 1,400 national banks and federal savings associations and about 50 federal branches and agencies of foreign banks in the U.S. These institutions comprise nearly 2/3 of the assets of the commercial banking system. The Comptroller also is the director of the FDIC and member of the Financial Stabilities Oversight Council. Prior to becoming acting Comptroller, Mr. Noreika served as partner in Simpson, Thacher, and Bartlett, and a member of the firm's financial institutions practice, where he focused on banking, regulation, and related litigation. He advised a wide range of domestic and international financial institutions on regulatory issues relating to mergers and acquisitions, minority investments, capital issuances, structuring and compliance activities, and litigation matters, particularly in the area of preemption. Mr. Noreika's experience, including advising regional, multinational, and other banks on the structuring of their operations, including complying with the Volcker Rule, CFPB regulations, bank secrecy, and anti-money laundering rules. He has represented national banks before the U.S. Supreme Court, U.S. Court of Appeals, and the U.S. District Courts. He previously served as a partner at Covington and Burling. Mr. Noreika has been also an adjunct faculty member at the University of Pennsylvania Law School and the University of Virginia of Law, and received his Juris Doctorate from Harvard Law School. Earned his bachelor from the Wharton School at the University of Pennsylvania. Mr. Noreika became the acting Comptroller of the Currency on May 5th of 17. However, Mr. Noreika hasn't acted much like an interim in the job. Observers have stated that taking tough positions is encouraged if you are doing what you think is best in executing on the mission of the office. Then that is your responsibility. Mr. Noreika is doing just that. It is my pleasure to present to you the acting Comptroller of the Currency, Mr. Keith Noreika.
All right, well, good afternoon, everyone, and thank you for that very kind introduction. I very much appreciate it, and I'm pleased to join you here today. And I'm happy to see so many OCC-supervised banks represented among the leadership of the National Association of Affordable Housing Lenders. I'm also proud of the role that national banks and federal savings associations play in community reinvestment discussions throughout the country. When I travel across our nation to visit with bankers, businesses, and community leaders, I'm struck by the quality partnerships working to restore and revitalize our neighborhoods. I was born and grew up in Pittsburgh, and I saw for myself the lasting transformative effects of banks and communities working together to restore a city. Today, my hometown is a shining example of what we can do together. That experience is one of the reasons why I personally share NAAHL's commitment to renewing communities and stimulating the nation's economy. At the OCC, we are continually looking for ways to remove unnecessary burdens that put limits on how banks can help invest in their communities. It makes no sense to have rules that hurt banks' ability to lend in neighborhoods that in return would make those neighborhoods better places to live, better places to do business, and better places to lend. In the few minutes that I have with you, I want to focus on what the OCC is doing to help banks lend to people who want to rehabilitate homes in distressed communities. I know that I stand between you and hors d'oeuvres, so I promise to be brief. Let's start with understanding the problem that we're trying to solve. In cities and towns like Detroit, one obstacle to healthy, livable neighborhoods is the quality of housing stock itself. Older homes often require special love and care, even in well-off communities. Pipes leak, wires fray, and roofs need replacement. Doors and bathrooms need greater accessibility for those with physical challenges, and in communities with higher rates of foreclosure and vacancies, these problems become exacerbated. In distressed areas, repairs to a dilapidated house can cost more than the house's appraised value. That situation means that even when motivated and creditworthy buyers find a house in this condition and they recognize its promise, they may not be able to get a loan they need to purchase and restore it. Traditional underwriting requires lenders to obtain appraisals or valuations to finance loans that can be complicated by the difficulty in identifying comparable values given the often limited home sales in a distressed area. One impetus for our guidance is that interagency rules generally provide that lenders should originate residential loans with loan-to-value limits in excess of 90% of a property's value only if there are appropriate credit enhancements. Together, the underlying condition of the properties and regulatory guidance itself act as obstacles for creditworthy buyers to obtain financing and help rebuild communities. Recognizing this particular challenge to lending and revitalizing communities, the OCC finalized guidance in August of this year that gives OCC-supervised banks and thrifts more flexibility to offer rehabilitation financing in distressed communities with depressed home values. The guidance for certain higher loan-to-value mortgages, commonly referred as higher LTV loans, explains how banks can establish lending programs to originate home mortgages greater than 100% of the home's value. The guidance applies to programs to originate mortgages in areas officially targeted for revitalization by government agencies that do not exceed $200,000, support the purchase and rehabilitation of owner-occupied residential properties, and do not exceed 10% of a bank's Tier 1 capital in aggregate. The guidance did not happen overnight. You can imagine the difficulty of convincing safety and soundness regulator that a loan that exceeds the value of collateral can be a good idea. A visit to Detroit in 2015 helped staff get past their reservations. During that visit, a group of senior OCC staff members experienced firsthand the need for rehabilitation financing while touring blighted neighborhoods. The goal of the meeting and the tour, arranged by an OCC-supervised bank and the Detroit Land Bank, was to start the search for solutions to the impediments home buyers faced in getting mortgages in the Motor City. At that time, Motown lagged behind the rest of the country and was still struggling with the effects of the housing market downturn and foreclosures. In the year before that meeting took place, only 490 purchase mortgages and 21 home improvement loans were made in the entire city. Detroit provided an excellent example of a community in need of revitalization. A number of banks and community groups wanted to do more to renew blighted neighborhoods, but could not overcome the obstacles to financing that work. That meeting provided former Comptroller Curry and OCC staff the reasons they needed to start developing a solution. During this process, the OCC received input from NAAHL's own Buzz Roberts, member organizations such as Community Reinvestment Fund USA, and interested bankers. Input helped the agency determine how such loans could be made without adding significant risk to the bank, while ensuring borrowers understood their risks in obtaining a loan for more than the collateral is initially worth. The final guidance, which was issued in August, explains our risk management considerations for banks establishing this type of programs. Banks should clearly inform borrowers of the potential risks associated with these loans. A program may also allow for situations in which a buyer may pay cash for a property and secure financing later, provided the buyer receives a bank loan commitment within 6 months to cover the purchase price plus projected rehabilitation costs. This flexibility allows buyers to compete more effectively for residential properties against investors or to bid at property auctions that require cash payment. In establishing their programs, banks should define the geographies where the loans would be made and how the loans will support community revitalization. They should establish governance for the loan terms and internal credit administration. The policies should include any provisions that address incentives and assistance qualifying borrowers may have, such as an assistance and grants for down payments, closing costs, and borrower counseling. While OCC approval is not required before a bank establishes a higher LTV program, banks should notify the agency in writing 30 days before they begin originating these loans. That notice should include the program's policies and procedures, which examiners will review the submission to assess whether the program is consistent with safe and sound lending practices. Thereafter, examiners will monitor the bank's programs during regularly scheduled supervisory activities. At least annually, the OCC will evaluate the extent to which participating banks' programs are contributing to the revitalization aspects of targeted communities. The OCC's guidance and the programs being established as a result of greater flexibility are beginning to make differences in communities that need revitalization the most. I am pleased with the response from a number of banks that have contacted us for more information, and staff members look forward to assisting other banks interested in establishing these sorts of programs. While programs established under the OCC's new guidance are helpful, the agency will consider other bank efforts to support revitalization that fall outside the scope of this guidance. These efforts will be considered on a case-by-case basis and must be consistent with safe and sound lending practices, promoting fair access to credit and fair treatment of borrowers, and comply with all applicable laws. One Midwestern bank discussed such plans with the OCC and has already established a program that is making loans to its community. First-time home buyers unable to afford more expensive new homes often shop for existing homes in older communities. These value shoppers looking for affordable housing explain why more than 40% of the existing homes sold in May were priced between $100,000 and $250,000. Many buyers also contribute their own hard work to fixing up these homes. Sweat equity can be an incentive to remain in their rehabilitated home and enjoy the community they help revive. All of these programs improve communities, and at the same time, they expand economic opportunity. In fact, community rehabilitation is a tremendous economic opportunity, considering that demographic and market forces are driving up overall demand for rehabilitation financing. A recent Harvard study shows that home improvement spending will grow by more than $50 billion a year between 2015 and 2025. That is a significant expansion in opportunity that can benefit banks of all sizes, particularly community banks. Community banks, like many of you, know your neighbors in ways that other lenders do not. You wear your school's colors and share your customers' pride in your hometown. The OCC wants to help you by assisting banks interested in offering or considering higher LTV lending programs. OCC staff are here to support your efforts to serve the rehabilitation financing needs of your customers. So we urge you to contact your OCC supervisory office to learn more about our guidance and to discuss your plans. Our Community Affairs Department, including our 11 locally based district community affairs officers, are excellent resources for you as you consider ways to lend and invest in your communities. Our district community affairs officers can help identify local community partners and help you educate the staff of government agencies and community development organizations on the revitalization needs of your community. Efforts like these produce real results that literally enrich neighborhoods. A recent study of blighted neighborhoods in Memphis, for example, shows that a local community development corporation increased home values $6 for every $1 invested in fighting blight. Fixing just one blighted house raised surrounding property values by 3%. Fixing multiple distressed homes multiplied the effect and raised nearby values by as much as 15%. This is a good way to turn a higher LTV loan into a more conventional mortgage and shows how benefits can ripple well beyond an initial action. If banks needed more of a reason to explore these programs are also eligible to receive community reinvestment consideration. Lending activities that revitalize or stabilize low to moderate income areas may be considered to meet CRA's definition of community development. Additionally, grants to support work of nonprofit counseling agencies that serve borrowers may be considered to be CRA-qualified investments. This is happening now in Detroit, where banks, community groups, and city officials are teaming up to spark a mini renaissance in some neighborhoods. Detroit has a way to go, but there is hope and evidence that things are improving, home by home and block by block. These are welcome changes for Detroit and can happen in other cities and towns too. In closing, I ask for your continued support in renewing and revitalizing distressed communities and stimulating our economy. The OCC urges you to use our new guidance in your efforts to transform blighted neighborhoods and make our communities more vibrant. I'm sure your actions will lead by their example and attract others who do not want to be left out when they see the positive effects of your good work. So thank you for your continued support, and I wish great success to NAAHL and to you in all of your future efforts. And now I'm happy to take a few of your questions. So who's the moderator of those?
Now, I can start off the questions.
All right.
And bankers in the room, if you could tell the institution you're from and where you are in the exam cycle, and we'll go like this.
Okay.
Acting Comptroller, Bill
Yes.
Fenton, we are at Bank of America in an exam
Okay.
as we speak. Where did you get your tie?
Where did I get my tie?
Those are the types of questions we're looking for today, so very good. Who's up first?
I got my tie out of my closet. That's the only
That's a
progeny I know.
terrific answer.
Yes.
Capital One, I don't know where he is in the exam, though.
We're right in the middle of one, but this is not related to our exam. So it was an issue that we talked about earlier today, and some of the people from the OCC came up to me afterwards and said, make sure you tell the comptroller as well.
Uh-oh.
So this is the opportunity. Forever, I think bankers have been very interested in better trained examiners in the CRA space because it is so different than most of the other examination work that your team has to do from a consumer compliance perspective, where it requires a lot of judgment, and really the better they understand the issues around CRA, the more successful the outcome of that performance evaluation is going to be.
Right.
But what we've actually been pushing for more than just training is to have specialized CRA examiners, especially for many of the banks in this room, the larger banks that get involved in really more complicated types of CRA activities.
Right.
So we would pass that on to you under advisement.
Sure. No, I appreciate the feedback, and certainly one of the things I've done a lot of is go out and talk to a lot of the examiners, both at the district and local offices that do the mid-sized and community banks, but also the large bank supervision teams. In some of the banks, we're fortunate to have people who are de facto experts, others not. I think Gravetta has done a good job of we're trying to, we obviously realized we kind of got behind the 8 ball. We had a big backlog. We're trying to get standardized procedures in place that are clear for the examiners to use and to implement. And then hopefully, I think you're right in the sense of there is that sort of need for more specialized examination expertise there. And that, I think, is something that then once we get the policies and procedures in place, then we have to work on that element as well. Yes?
Good afternoon, Comptroller. Lloyd Brown with Citi.
Yes.
I think it's rare that examiners, regulators, Comptroller get a thank you. And on behalf of the banking industry, I want to thank you for the leadership of the OCC with regard to the downgrades. I think that the rule is a sensible rule, and requesting a nexus demonstrates to community organizations that banks don't get a pass. And it's a right step in the right direction. So, simple comment.
Yeah, and then look, I can comment a little bit on that. I mean, my own feeling is we want CRA to serve its purpose of getting banks to invest in their communities. And I think one of the worries, maybe expressed by you all, but just sort of intuitively, as somebody who's studied in this area for 20, 25 years, is there's a notion of the quote piling on of and the like, and I just, this is sort of taking, if there's no nexus, I think there's a worry we're making. I don't know whether weaponizing is the right word, but it's sort of taking CRA away from its original purpose. And so I think everything you do with CRA, as far as what penalties may come from compliance violations, have to be filtered back through what the original incentives are. And so, look, I'm one of these people. I've always, throughout my legal career, you sort of set down the strongest arguments on both sides, so you get like two pieces of paper. And I think when you set those down, like first, on one side is, well, compliance shouldn't be tied to CRA. CRA is for getting you to invest in your community. Compliance can be handled through other ways. We have the CFPB. We have other type of regulatory powers, enforcement actions that we can take against those banks. On the other side, I think is a strong argument that if you're going to be lending in the community and claiming credit for it, you should be doing it in a way that's compliant. And it seems to me the most sensible way to marry up those competing concerns are to require that nexus. So, the lending that you do to claim credit should be compliant, but we're not looking beyond that, because I think then you are starting to get into the risk of, really de-incentivizing or diminishing the incentives to engage in the activity in the first place. All right, next.
Comptroller, my name is Cliff Kellogg, and I wanted just to commend the OCC for taking on that exceptionally difficult task of looking at the Detroit marketplace. And that really was a case where seeing could help show what the banking need was, more than trying to look at it remotely and statistically only. And so I had the privilege of working with many of those banks and with the mayor in Detroit, and worked with the community development staff of OCC. And I encourage you to come visit Detroit, and I encourage you to, and the staff, to keep looking for those kind of localized conditions that call for extraordinary and special underwriting. So thank you, and thank your OCC team for this really good work in Detroit.
Well, I absolutely would love to take you up on your invitation. I mean, my own orientation to this issue came through a more bureaucratic way of trying to break the guidance free from the Office of Management and Budget, who had to get final say on it being published for a law that, again, we're sort of getting into the weeds of administrative law. But, in talking with Barry and Gravetta, it seemed like this was an incredibly good idea, and that, we need, eventually, I guess I had to educate the head of OIRA about this, probably on 2 or 3 calls, because it seemed like a no-brainer to me. That we would want this out there, that we would want clear guidance that banks, if they want to take advantage of the opportunity, should be able to do. I can't imagine, it seems like a good idea sort of that anyone could agree to, but it was just a matter of sort of educating them the process of how it worked, and I'm glad that we were able finally to get that out. Everyone wants food? All right. Well, thank you very much. All right.